Welcome to the Pro Ticker Deep Dive. Conventional wisdom in finance is often beautifully simple. When the Federal Reserve cuts interest rates, banks cheer.
Right.
Lower rates should mean a healthier economy, fewer defaults, and, cheaper borrowing costs for the banks themselves.
Hmm.
But 2025 it proved that equation is dangerously oversimplified.
Completely.
By the time the Fed delivered its final December rate cut, we weren't looking at a rising tide lifting all ships. We were looking at a stark, painful split in the banking sector.
That's absolutely right. Our sources confirm that the idea of lower rates being universally good for banking is, well, it's dead. We saw mega banks not just survive, but actively thrive.
While many regional and community banks found themselves caught in this vicious, counterintuitive financial squeeze.
Exactly.
And our mission today is to figure out why. We are diving deep into the structural economics that created this divide.
And it all comes down to, really, three key pressures: margin compression, the stubborn reality of deposit stickiness, and a truly massive albatross hanging around the neck of smaller lenders' commercial real estate exposure.
So you might think you know how the rate cycle works, but this is where the reality of modern finance gets really interesting.
Okay, so let's unpack the macro backdrop first, because 2025 was really defined by the pivot.
The big pivot.
Yeah. We had spent years with the federal funds rate up above 5.25%. The Fed decisively moved into an easing cycle, which, culminated in that December cut that landed the rate in the 3.5 to 3.75% range.
That was a huge move. It signaled the end of the post-pandemic inflation fight and, I guess, an admission that global growth was slowing.
It was. And it was globally coordinated. This wasn't just a U.S. story.
Ah, okay.
The Bank of England, for instance, they delivered 6 rate cuts just between August 2024 and December 2025. When you look at the 9 central banks overseeing the world's 10 most traded currencies, 8 of them were cutting in 2025.
So a globally unified signal that money was getting cheaper.
Right.
Which brings us back to the puzzle. If the price of money is falling globally, why does the traditional banking model, the simple act of lending money out for more than you pay for it, why does that suddenly stop working? Why the squeeze?
The squeeze is net interest margin compression, or NIM for short.
The NIM squeeze, yeah.
That's the profit engine of a traditional bank. It's the spread between what they earn on assets, their loans, and what they pay on liabilities, mostly deposits.
Okay.
When the Fed cuts rates, 2 things happen really fast. First, the yields banks earn on new loans and floating rate assets. They drop immediately. That's the revenue side falling off a cliff.
And crucially, the cost side, what they pay their depositors, didn't follow suit. It got stuck.
Precisely. That is the fundamental problem of deposit rate stickiness. The regional banks were forced to slash their lending rates throughout 2025 to compete, but the cost they paid to keep deposits remained stubbornly high.
So it just instantly crushed their margins.
Instantly.
Yeah.
It hurts any institution that's heavily reliant on that simple lending spread.
That structural shift feels like the critical factor here, the thing that makes this easing cycle so different from ones we've seen before. It implies that the average bank customer is now, fundamentally different, more financially aggressive, maybe?
They are definitely more aware, and that awareness was forged in the fire of the 2023 regional banking crisis.
Right, SVB, Signature Bank.
Exactly. Those events taught depositors a harsh lesson: always be rate shopping. Cash immediately began moving out of non-interest-bearing accounts, your classic zero-cost checking accounts, and just surged into high-yield products like CDs and money market accounts.
So this isn't just a temporary trend. It's more like a permanent evolution in how people bank.
It is a structural and, I think, likely a permanent change. Let's look at the data, which really shocked our analysts.
Okay.
Interest-bearing deposits. They surged from 71% of total deposits just 3 years prior to 77% by mid-2025. Think about that. Nearly 4 out of every $5 in a regional bank's portfolio is now actively costing them money.
77%. That's staggering. If that much of your liability is now expensive, why couldn't banks just drop their deposit rates faster in 2025? Were they genuinely worried about starting, a new bank run?
That is exactly the dilemma. While they slowly cut deposit rates throughout 2025, the average funding cost still sat at 2.09% mid-year, which is miles above the pre-pandemic norm of 0.9%.
A huge difference.
And if they moved too fast, they risked customers pulling that expensive money out entirely and moving it to a competitor offering even 10 basis points more. For smaller institutions, that funding cost was even higher, averaging 3.15% in 2024. They are effectively paralyzed.
So they're trapped between the fear of margin collapse and the fear of losing their entire funding base. And this pressure isn't just from consumers, right? Corporations are playing this game too.
Oh, absolutely. The commercial side is often even more ruthless about yield. We used to rely on companies keeping huge amounts in traditional non-interest-bearing demand deposit accounts, or DDAs.
The free money, basically.
Free money. 3 years ago, over half of commercial deposits were sitting there. Now, only about 1/3 of commercial deposits avoid interest payments altogether.
That's a huge shift in corporate treasury behavior.
It is, and it means the old, reliable, cheap funding sources they've dried up. One consultant we reviewed described this shift away from DDA as a slow ship to turn around.
And for the regional player, that slow ship is full of expensive, sticky funding costs that aren't going anywhere fast, no matter what the Fed does.
Exactly.
So we have this double whammy. Loan revenue is falling fast, while funding costs are locked in high. That's bad enough. But for regional banks, there was a third massive weight that the mega banks largely avoided.
The commercial real estate anchor. This is the compounding crisis. NIM compression is an industry problem, but CRE exposure is disproportionately a regional bank problem. Our sources referred to the struggling office sector, in particular, as a zombie space.
Zombie space. That's powerful imagery. Tell us why that term is so fitting.
It's fitting because the properties aren't quite dead, but they certainly aren't healthy or productive. Persistent, sticky work-from-home adoption has just permanently reduced demand for office space.
So the buildings are there, but the cash flow isn't.
Right. Many properties are now effectively underwater, with values below the loan principal, just as those 5- or 7-year loans are coming due and need refinancing in a really tight credit market.
That's a huge pool of risk. What is the scale we are talking about here?
The scale is immense.
Yeah.
Banks held approximately $3 trillion in CRE loans as of late 2024. That's about 12.7% of total assets. Delinquencies are rising steadily.
And because regional banks are so concentrated in specific geographic markets, that risk it's not spread out.
Exactly. It's highly concentrated on their balance sheets.
Can we look at a specific regional player to put this into perspective?
Certainly. Let's take Citizens Financial Group, a big regional player with over $200 billion in assets. They initially had about $4.2 billion in office CRE exposure.
Okay, that's a big number.
It is. Now, $4.2 billion is manageable relative to their entire asset base, but it still consumes an extraordinary amount of management time and attention. They are grinding this down, calling it a multi-year journey.
A multi-year journey implies the pain is baked in for years to come.
It absolutely does. They noted an interesting detail, too. Only 30% of their exposure is in central business districts, with 70% in suburban offices.
And suburban is doing better.
Much better.
Right.
Defaults there run at roughly half the rate of the downtown properties. So even the best-managed regional banks are focused purely on damage control, not growth.
And that focus on damage control creates a vicious cycle, doesn't it?
It's a terrible feedback loop. Managing these CRE workouts forces banks to aggressively set aside capital in the form of loan loss provisions for expected future defaults.
So they're putting money aside for loans they know are going to go bad.
Precisely. JP Morgan, for instance, saw its provisions jump sharply, reflecting their own internal caution. When regional banks are spending capital on losses and management bandwidth on these complex negotiations, they have less capacity and less willingness to generate new, high-quality loans.
They become cautious lenders, which suppresses their own profitability for the long term.
Exactly.
This is where the contrast with the mega banks becomes so striking. While regional players are stuck in the trenches fighting this two-front war deposits and CRE institutions like JP Morgan, Bank of America, and Citigroup, they seem to be soaring above the conflict. What gives them that incredible lift?
Their success is built on two things the regionals lack: a deep, stable deposit base that's often global, and fortress balance sheets. But the real key, it's robust revenue diversification.
Meaning they don't live and die by their net interest margin.
Not at all.
They thrive on non-interest income streams, investment banking, trading, wealth management fees. These seem to be unaffected or even boosted by the same rate cuts that are crippling the regionals.
That's the paradox of the easing cycle. While their NIM might compress a little, rate cuts stabilize the financial outlook and, critically, often increase market volatility in the short term.
And the trading desks love volatility.
The capital markets divisions love it. When rates are cut, it spurs renewed activity, as corporations emerge from, holding patterns.
So falling rates unlock previously frozen corporate activity.
Exactly. Cheaper borrowing costs and greater certainty spur corporate debt issuance, bond underwriting, and, crucially, mergers and acquisitions. That activity directly fuels the investment banking fee revenue, which acts as a powerful hedge against falling loan yields.
The numbers from the first quarter of 2025 really bring this into focus.
They absolutely do. JP Morgan Chase's revenue rose 8.1% year over year. That wasn't about the traditional banking model.
No.
It was driven by trading revenue soaring 21% and investment banking fees jumping 12%. Their net income surged over 9%.
And Citigroup showed the same dynamic, but even more pronounced.
Citigroup's net income jumped an incredible 20.6% year over year, driven by gains across 5 major segments. Their massive global footprint and wealth management divisions provided a cushion the regionals simply can't access.
Even Bank of America did well.
Yeah, even BofA, which is more sensitive to NIM than JP Morgan, still saw a net income climb almost 11%, backed by a rock-solid Common Equity Tier 1 ratio of 11.8%.
Wells Fargo was the outlier among the big four, right? They suffered some NIM pain, similar to the regional.
They did. Wells Fargo saw their net interest income decline 6% because they had a lot of floating rate assets that repriced lower very quickly. But even so, their size and operational control allowed them to maintain tight expense discipline and still eke out a 6% profit gain.
It proves that scale matters even when your business mix isn't perfectly diversified.
It really does.
Looking ahead, these megabanks have continued tailwinds, especially in wealth management.
That is a critical long-term growth engine. These large institutions collectively still only hold about 32% of the global wealth management market.
So there's a lot of room to grow.
A huge runway. As capital markets rebound, high net worth clients seek comprehensive services, estate planning, tax, advisory, all of which generate reliable fee-based income streams that are completely independent of the short-term rate cycle. They're poised to capture a bigger piece of that pie.
Okay, let's pivot and build an investor's playbook based on this deep dive. The divergence is so clear that you just can't look at banks as a single sector anymore. Regional banks were trading at historically compressed valuations, PE multiples around 11.8, price-to-book ratios near 1.15. That discount is the market pricing in all this risk.
That discount is warranted. When we analyze this sector, we see 2 primary banking systems, plus, one hidden opportunity.
The first system, the megabanks, looks like the obvious choice for stability and growth.
Absolutely. Buy the megabanks, JP Morgan, Citigroup, BofA for stability, pricing power, and fee growth. They are built to thrive, whether rates are high, low, or moving, because they aren't solely dependent on NIM. They are just resilient and diversified.
And the second system, the undifferentiated regional banks. The ones still stuck fighting the NIM and CRE wars.
Avoid them. Our sources are clear. For the broad sector of undifferentiated regional lenders, the risk-reward imbalance is it's unfavorable. The CRE workout cycle is a multi-year effort that will suppress their returns for the foreseeable future. There are too many structural headwinds.
But you mentioned a third group, the overlooked winners, the specialized players that the market might be punishing unfairly because of all this sector negativity.
Precisely. This is where the asymmetric return opportunity lies. You need to hunt for small to mid-sized banks with minimal or zero office CRE exposure that have successfully pivoted into specialized lending niches.
And why are those niches like agricultural lending or equipment financing or healthcare lending more resilient?
Because they maintain pricing power. This type of lending is often secured by tangible assets. It's high touch. It's relationship-based. And it faces less direct competition from the megabanks, who just don't want the hassle of these smaller specialized markets.
And they're trading at a discount.
A deep discount, sometimes as low as 0.8 to 1.0 times price to book, creating potential value if they can prove their resilience.
So, if structural economics, not just Fed policy, dictates success, what is the single most important metric for our listener to monitor moving forward? What separates the survivors from the rest?
You must monitor deposit dynamics, specifically the trajectory of interest-bearing deposits and what are called deposit betas.
Unpack that concept for us, deposit betas.
Think of the deposit beta as the bank's flexibility rating for its funding. It's the rate at which a bank's deposit costs decline as the Fed cuts its benchmark rate. Banks with low declining deposit betas, meaning their funding costs are quickly getting cheaper in a low-rate environment. They're managing the transition well and showing pricing power over their customers. Banks stuck with high, rigid betas are locked into expensive funding.
So it's the key indicator of who's in control and who isn't.
It's the key. The structural reality here is profound. We are not just witnessing a cyclical banking slowdown. We are seeing the slow, painful death of the undifferentiated local lender, forced out by a financially savvier customer base and a massive shift in how corporate cash is managed. The banks that thrive in this environment are not the ones hoping for easier macro conditions. They are the ones who have built genuinely resilient, diversified businesses that succeed regardless of where the Fed sets policy.
See you all in the next Pro Ticker Deep Dive.